The market's roller coaster ride this year has left investors on edge. And with President Trump's new tariff plan, the turbulence shows no signs of stopping. So, should you sell, hold tight, or buy the dip? We've got your essential investor's guide to navigating volatile markets. And Tyler, you, like everyone, you've been trying to reassess the risk here, and you've also been rebalancing your allocations amid this uncertainty. So how are you thinking about the uncertainty, and what kind of process are you going through to rebalance?
Yeah, look, I mean, the market the last couple of years has been fantastic. And so if you've been a 60-40 investor, a balanced investor for the last 2 years and done nothing, your portfolio is now a 70-30 portfolio. So you're taking on a lot more risk than what you may be expecting. And so that's why we've been advocating for our clients to rebalance their portfolios and reassess their risk overall, because there just is so much uncertainty. And even when we get the announcement today, who knows what's going to happen after that? Right? There's a changing landscape. The tariff market, if you want to call it, is very, very fluid right now. And so these tariffs could be gone, or certain items could be excluded from tariffs in a couple of days. Who knows? So there's just a lot of uncertainty. And so that's why we're trying to reassess our risk and rebalance our portfolios to pull back on the aggressiveness.
And are you going still back towards that traditional 60-40 model here? Is that an appropriate sort of balance for you? Are you retweaking things within stocks, for example, to go more defensive? How is that playing out?
Yeah, it really depends on the investor, right? So a good example of what we've been doing is in a full equity portfolio, full growth portfolio. We've actually held what we call a hedged equity position. So that's been including buffered ETFs. It's include covered call strategies. It allows us to have some type of protection, or take some of the profits that we've had over the last couple of years and try to mitigate some of these losses, because we are expecting volatility to return this year. Our theme has been bring an umbrella. So we've been expecting some type of pullback or correction in the market. So that's what we've been doing in our portfolios, is adding those types of things to try to protect us on the downside if there is that correction, which we are now seeing.
And what are you telling your clients in terms of your outlook for whether things are going to calm down in the short term?
Short term, I think we're going to continue to see the volatility, quite honestly. But our view is that we'll end the year positive, right? So we have to weather these storms. These types of corrections are normal. There's different catalysts to all of these corrections. But going all the way back to 1980, the average correction in the market each year is almost 14%. And so we just saw the dip a couple of weeks ago below 10. We're now sitting about down 8%, down 9. So this is normal course of action for the market. So there's no reason for our clients to panic, or any client to panic at this point. We have to assess what these tariffs are going to do to the companies. And so for right now, we need to make sure that we're remaining invested rather than trying to time the market at this point.
And let's talk about some of the things that you're getting invested in. Seeing the dip, you're maybe stepping in here. One of the examples is Walmart, which I think is really interesting. Obviously, the company gave an outlook that the market didn't like, talked about caution around the consumer. At the same time, we've seen reports that Walmart is trying to sort of exert some pressure on its Chinese-based suppliers in the face of tariffs. So why do you see that as an opportunity right now?
Yeah, certainly Walmart will be facing tariffs with a lot of the products that they're importing. But we have a changing consumer landscape right now. Consumers are still grappling with price increases from 2021 and 2022. And now we're starting to talk about these tariffs. And so that changing landscape, consumers are going to be going to the lower cost items. They're going to be focusing more on the grocery area because those are the necessities that they need. And that's really where Walmart plays. And you can compare them to Target, right? Where there's a lot more discretionary spend at Target versus necessities at a Walmart. So that's why we like Walmart. It's pulled back that 15% or so. And so I think this is a good buying opportunity for a longer term investor.
And then there's one other pick I want to pick your brain on, so to speak. It's tax season, right? So Intuit is one of your picks. And that's a stock that is sort of, had its ups and downs, so to speak. Why now is that one that you're looking at?
Yeah, look, there's two things in life that I would say are certain: death and taxes, right? And so when we start thinking about how Intuit can incorporate AI into their platform and then start charging different tiered areas for different use cases within AI and utilizing those to complete your taxes, I think going forward, yes, Intuit is a little bit more expensive, but the growth that they can provide and the necessity of taxes, it's a tailwind going forward for Intuit at this point. And so on this pullback, I know they have had their ups and downs, certainly, but I think this is a good opportunity at this point to step in here.
Joining me now is Brent Kenwell, eToro U.S. investment analyst. So that all may be the playbook normally, but today is not a normal day, Brett. And so I'm curious if even on a day like this, you see retail investors buying the dip.
Yeah, so when we did this survey, just for context, the dates were we did it between February 18th and March 4th. So it really caught, the high in the S&P and then, those really kind of the first half of the correction. And, to me, it came back as surprisingly optimistic, surprisingly positive, certainly stronger than I thought. But I do imagine that sentiment has taken a little bit of a hit in the recent weeks. Just as like everything else has kind of come in and come under pressure, we see confidence continue to move lower. We see investor sentiment continue to move lower. So I wouldn't be surprised if retail hasn't been able to buck that trend as well. But it's going to really depend on how things shake out going forward from here, whether that's related to the tariffs or more importantly, as it relates to the economy as we kind of sort through Q2 and push into the second half of the year.
And Brett, what do we tend to see at times like this when things get even more volatile? And what kind of action do you tend to see and are you seeing on the platform?
Well, as it relates to retail investors in general, I think at first they have a tendency to really embrace the dip. Going back into this survey, we asked specifically about holding periods and how long investors, what their time frame generally is. And a majority were in either measuring between years or decades. So this tends to be a group that looks a little bit longer term. And when we're kind of dealing with that, in the context of time frame, it's easier to deal with these sort of periods, even though this is a hard, period to navigate with volatility, emotions are high. When your outlook is in the years instead of weeks or months, it's a lot easier to embrace a 5 or 10% correction. If we get into that 15, 20% correction, tiptoe into a bear market, then I think, it does get a little harder to embrace those dips. We saw retail appetite for the dip pretty strong January, February, but I think that appetite has waned a little bit, as has patience and as has certainty, really over these last 4 weeks or so.
And what about when it comes to big cap tech, which has been the thing that has been, probably what retail and institutional investors alike have been most enthusiastic about, the AI trade, et cetera. Is seeing any wavering there?
Interestingly, I personally think that a lot of the sentiment declines in market-wide sentiment are tied to tech. When you look through dig through the Q1 results, the performance results of the S&P sectors, a majority of them did pretty well. The weakness was really tied to consumer discretionary and tech, which, in this case, unfortunately, accounts for more than 40% of the S&P 500. So a bulk of the sectors actually outperformed the index itself, but that weakness in tech really weighed things down. Now, what's surprising from the survey is how sentiment didn't really waver from, quarter over quarter. Confidence in Magnificent Seven stayed the same. 48% of respondents expect the Mag 7 to outperform the S&P this year. Confidence in AI stocks actually went up quarter over quarter, which again, so when we did this survey, it was after the DeepSeek news, after the volatility in AI. It was once tariffs were on the table. So to not really see the confidence waver in mega cap tech or in AI was surprising to me.
And did you see any changes from sort of different demographics on the platform?
Yes, Gen Z wasn't an asset class; it was a generation, and it was Gen Z. They really, I think, from the survey results, they seem to have really kind of handled the moves in the market really well over the last 6 months. So when we last did this survey, again, for context, the prior survey was done between late November and early December. And we saw this really risk-off rotation from Gen Z. So they were rotating into cash, rotating into bonds, which was, surprised me because it's a younger generation. They tend to have a larger risk appetite and be more risk on. fast forward to this quarter, now we're seeing all that rotation come back out of cash. They went from 75% of respondents saying they had a cash position down to just 60%, but big increases across the board, whether it's in crypto, domestic stocks, foreign stocks, commodities, which our read-through was silver and gold in that scenario, but really kind of embracing all sorts of different asset classes and sectors, which is, in a way, it looks like they took advantage of the big run up in Q4 and are trying to take advantage of the dip in Q1.
Following President Trump's tariff announcement, the markets tumbled. But Margie Patel, portfolio manager at Allspring Global Investments, explains why staying the course could be the key to long-term gains. Margie, what should investors do right now? They're looking at this sell-off that, by the way, is not in isolation, right? We've already seen stocks pulling down this year. So what should investors do as they see this happening?
Well, I think what they should really do is nothing, because at this point, we really don't know what the effects will be on the tariffs. It looks as if short term it may be negative, but longer term, it looks as if it will be on balance positive for the U.S. economy. Some of these unfair trade barriers really did hurt our domestic base in the industrials, and I think that will be corrected. And really, these actions have been extremely sudden. We're not used to seeing that. And I think looking at President Trump's economic team, they're very smart, successful people. And if it looked as if we're going to have disaster the way some of the stock prices tell us, I think they can pull back just as quickly as they advanced on these. So bottom line, I think long term it's positive for the U.S. And when we don't really know anything about the market, it's best to do nothing and not follow the lead of really short-term traders who've driven down the market pretty much this year.
Do you think that there's a case to be made for taking any kind of defensive posturing in the market?
Well, from the stocks that have done the best, they all have gotten really hit the hardest. Those are the sectors that I think long term will still be the strongest. Now, for example, technology, industrials are related to capital expenditures and improving the electrical grid, and also domestic energy, which I think will be a strong area. And I think, like I said, I think it's important to keep in mind the volatility is really driven not so much by people who know more than the average investor, but really short-term traders, which is really dominating, I'd say, way over half of all the trading. I think actually in the financial crisis, giving up the uptick rule, which limited the downside action of stocks when people wanted to short, has really caused a lot of this volatility that's so disturbing.
But Margie, it's not just short-term traders. People are worried, right? You look at consumer surveys, you look at CEO surveys, you look at some of the early indications we've gotten on earnings. None of that's been good. So, it's not as though the stock sell-off is just based on only short-term traders. There are some bigger forces at work, no?
Well, that's right. And I think the biggest force of all is coming into the new year. You really had to realistically expect rather modest growth in the U.S. economy. I was really thinking, say, 1.5%, 2%, which is lower than many estimates. And I think part of that is we're seeing a deflation in stock values. But still, when you look at the market, we had before this 2 fabulous up years, 25% for the S&P in 2024 and 23. And then we had a down year previous to that. Before that, we had 3 up years, and we haven't had another down year since 2018. So I think we've been kind of spoiled with positive markets. But I do think when you look at even sectors like technology, yes, there's a lot of concern about the tariffs and slower demand and so forth. But even if you haircut their growth rate, many tech stocks are trading really with a lower price earnings ratio than the average S&P stock, or really slightly in line or a little above. So we think that many of those are bargains. But I do think we aren't going to see the market stabilize until we have something to crystallize, some positive event, whether it relates to tariffs aren't as bad as we thought, or there's a change. Maybe the Fed will cut rates instead of keeping a stable policy. So I think we may have to wait another quarter or so to see the market find its footing. And then I think it'll do better because the U.S. economy is strong. In fact, you saw the other day, auto sales were very strong at a 17 million rate. And
Well,
you can
that's
say,
because people were buying cars in advance of the tariffs, no?
well, correct. But still in all, if you don't have the money to buy a car, you're not going to buy a car. So it's a very good current. People have money in their pockets to buy cars. Even if you haircut back to 16 or 15, that's still quite strong, indicating consumers, they may be worried, but basically the job market is okay. The numbers today were okay, mixed and looking at modest growth, which is what we're looking at. So we think that it's best to just hold tight, not pay attention to the market and say, well, you have to expect every few years you have a negative year. And over time, you'll still make more money than if you were in risk-free assets.
Margie, I'm curious about the next potential catalyst, jobs on Friday, right? And how much is riding on that now, especially given what's going on in the market today in the wake of the tariff announcement?
Oh, I think that these monthly numbers that we see are too small to move the needle and say, oh, it's okay, we can jump back in the market. I think it's really the bigger picture of what's happening with, particularly with tariffs and how U.S. companies react to those. But really, we've really gotten to the point where we had to do something. And if you look at Europe, Europe is absolutely just sinking in the mud. They are way over indebted. Their economies are basically absolutely flat. They have no promise of growth. So you can see why they're very, very disturbed by these tariffs. But I really don't think it's going to roll over to the U.S. economy. I think we're going to be able to have positive growth. And as I said, if I were going to look at averaging in, I'd say put 10% in today, 10% in next month, and I think in the next 6 months we'll be pretty pleased.
Next, Tobin Marcus, Wolfe Research head of U.S. policy and politics, shares why the markets were taken by surprise and shares how optimistic we should be about the market's global sell-off. With markets looking grim, is a rebound on the horizon? Tobin Marcus of Wolfe outlines a potential path forward and what needs to happen for investors to regain confidence. Joining us now, Tobin Marcus, Wolfe Research head of U.S. policy and politics. Tobin, why was everyone so taken off guard here?
I think the scale of the tariffs that ended up being announced is a little hard to believe even after it's happened. And so it's not terribly shocking to me that investors had a hard time getting their head around the possible scale of this in advance. Our low end of our range of estimates of what this might look like was higher than some of the other point estimates we saw elsewhere on the street. And this came in higher than the high end of our range. So I think it is definitely an adverse surprise, even to our relatively hawkish expectations. Not, I think, shocking that caught some investors flat-footed.
And about half the folks you surveyed think that there's still negotiation hope here moving forward. What are you telling clients about the likelihood of these tariffs being negotiated downward?
So I am somewhat pessimistic about the prospects for negotiation here. I think when you look at the structure of these tariffs, on the one hand, you have the 10% floor, which limits how much relief most countries are realistically going to be able to hope for. And then the way that these reciprocal tariffs were set, these ostensibly reciprocal tariffs, was based on an imputation of the value of the total trade barriers from any given country based on the scale of our trade deficits with that country. So we're essentially treating bilateral trade deficits as a big problem per se, as a national emergency, in the president's words. And that's going to be a really challenging thing for countries to change overnight. No matter what policy concessions they're offering, whether it's lowering tariffs, lowering non-tariff barriers, it's going to be really hard for any of those policy shifts to make a dent in actual trade deficits. And so insofar as that's been the president's target, I think that's going to be a hard thing to move the needle on.
Tobin, just to translate that a little bit for folks who are not as familiar with some of this trade language, basically the trade deficit is the difference between what I sell to you and what you sell to me, effectively, right? That's the trade gap. And I believe that this was just calculated on goods alone, not on services, which is fascinating because the U.S. is sort of much more dominant in services than it is in goods, right? So what does that also say about whether there's any hope for these things to be reduced?
That's exactly right. We run a big global trade deficit when it comes to goods. We import a lot more goods than we export. We run a significant global trade surplus when it comes to services, with education, financial services, some others being major strong points for the U.S. So on the one hand, I think that exposes U.S. tech companies and other service exporters to retaliation. We'll have to see whether or not other countries are willing to cross that bridge. I think retaliating in that way, rather than just retaliating with tit-for-tat tariffs on U.S. goods exports probably does increase the risk that the U.S. will counter-retaliate, as Secretary Bessent was warning about yesterday. But the president's goal here is a reindustrialization of the country. The way he has articulated what he's trying to achieve here is that the goal here is to effectuate a long-term restructuring of the U.S. economy in which we're rebuilding our industrial base. So I think that's why we're seeing the focus on goods that we have seen in the structure of this policy.
And we're already getting retaliation announcements from several countries this morning. We're going to throw up a chart right here indicating some of those retaliation efforts that we are seeing from the likes of Germany and France, for example. Here, the EU chief talking about how they are prepared for countermeasures, China and Spain coming out as well this morning. Then Howard Lutnick saying tariffs will go up if a country retaliates. Given that, how bad could these tariffs get if we continue to see the trend we've seen from this morning continue in terms of retaliation?
Yeah, it's really hard to game out exactly how this will go. I do think there is some risk that the tariffs could go up in response to retaliation from other countries, especially if those packages of retaliation include some of these more unorthodox measures like retaliating against U.S. tech companies and other service providers with things like digital services taxes. So I think that is a very sensible concern. Of course, the tariffs imposed yesterday are already immense. So we don't know for sure what appetite the president is going to have to take those further up. But I do think that they will be thinking twice in Brussels and other foreign capitals about exactly how much risk they're willing to take of provoking a further response from the administration. But I think most countries are going to feel like they have to respond somehow. Perhaps not countries like Vietnam, where they're just in a really disadvantageous position here. But peer countries and blocs like the EU, I think, are not going to be willing to take this sitting down with no response at all.
Tobin, beyond tariffs, given that the market has gotten this so wrong, as you said, it was tough to get it right. What else are we getting wrong? What else are market participants getting wrong? And I'm thinking in particular of the tax cuts that a lot of investors seem to be pinning their hopes on to sort of rescue us from this tariff situation.
So, starting on tariffs, I think there is still a big question about durability. And frankly, I think that we would be seeing even bigger declines today if investors were assuming that this stuff is going to stay in place. Again, we are somewhat more pessimistic on that front. So I think we're not necessarily past the point of people having excessive optimism about the tariffs. When it comes to the tax cuts, I do think those are coming, likely in a July timeframe for final enactment. There will be some net fiscal impulse, some stimulus that comes out of those in 2025 and 2026. If these tariffs were to stay in place, that fiscal impulse is much smaller than the face value of the tariffs. I mean, a factor of 4, roughly. But, if we start to see too much economic pain from the tariffs, it's possible the administration is capitulating as we get into late Q2, early Q3, in the face of economic weakness driven by these tariffs. If we start to see tariff easing that then leads into the tax cuts being passed, I think that would be the optimistic narrative about how things could turn the corner over the summer.
Thanks for watching. Keep it here on Yahoo Finance for the latest market insights and expert analysis to help you stay ahead.